Hello everybody, welcome to another update on the Gold Forecast Index, the holy grail to predicting gold prices. In my last video I said that gold would go higher, and that has happened. So you can see here that we broke out and we are now testing the resistance at 1800. So technically this could break out or it could retrace. So we're not sure what this will do yet. So if you want to wait it out, then, well, you can wait until it breaks out. But let's take a look at our gold forecast index, because this will tell us what gold will do. And I have a bit of worrying news, because the gold forecast index has plunged. And let's analyze what the reason behind this plunge is, because this plunge is really big, and well, it coincides a bit with the plunge in gold from 1800 to 1700. So this big plunge is just a small plunge in the gold price here. But you need to know that this index is based on leading indicators, and these are the leading indicators which will predict the gold price. Capacity utilization has been trending higher, so that's no problem. The trade balance has been going into deficit, so that's also not a problem. M2, money supply, is going higher, also not a problem. Producer price index has been going higher. The Swiss franc has also been going higher. So the only problem in the gold forecast index is the 10-year yield. That's the most important parameter that has caused this plunge. So let's take a look at the bonds. And when we look at the bond yields, you can actually see that if we take March, because the data is from March, we have a bond yield of 0.8% last year, and that has now risen to a bond yield of 1.6, 1.7 even. So that's a very big rise in the bond yield, and that has caused this massive crash in the gold forecast index. It's still in the positive area, so that means there's still growth in the gold price, but probably not as fast as we would expect. So don't expect gold to go to 2000 in a month. This will be a slow rise, grinding higher into the end of the year. We could have corrections here. So let's keep watching the 10-year yields. This is the most important parameter to watch. Also, we had a new data point for the Taylor roll rates. We had new GDP numbers. This is still in positive territory, even improving, which means gold is likely to go higher. We also had new data on the misery index due to higher inflation, consumer price index. This index has moved back up, also very positive for gold. This data is still old. Chile and Peru, nothing changed there. We still have the same levels of production. The GLD stock level has been going down, which means the investors are not buying gold yet. So the large institutions don't like gold yet, but they will come when the gold price starts to break out. We don't have extra data on SGE yet, so I'm still waiting on the April numbers. SLV has been going down, so no interest in SLV yet. The Shanghai silver warehouse has been bottoming out, so we are seeing an uptick in demand for silver in the Chinese warehouses. So that could mean that silver is about to blow higher. You can see this bottoming and this bottoming coincides with a rise in silver. So silver has a lot of potential to go higher. We don't have new data on central banks. US Mint sales were not that good. So these were the April numbers. So you can see that gold and silver sales were down. Probably also because the US Mint closed down. So if you close down, you can't sell any coins, of course. Premiums are still at 50%, even though silver has gone up. So that means silver has much more to go higher, as premiums will go back to the historical level. So everything is looking good. Shanghai premiums still above zero, that's also good. Gold premiums still at 7%. PSLV premiums were at zero. They were a bit positive, but now they are back at zero. The gold COT report, which is very important, you can see that the shorts are still lower than they were a year ago. So that means that gold is bottoming out. Silver is not that good a report for COT. You can see that there are more commercial shorts coming in. So don't be surprised to see a silver price smash by JP Morgan, because the shorters are coming back on silver. That's also visible here. Shorters are going back. Gold is more positive. This is better than this. LIBOR rate is still at zero, while the lease rates are moving higher. Let's take a look. Lease rates for gold are almost at zero, so we are almost at backwardation. But I want to see this go above zero. For silver, we see a little spike here, which means silver has potential to go higher. Let's take a look at the tips. You want to see this trend up, and we see that it is stabilizing. So gold is probably stabilized here and will slowly move higher. Seasonality, we are now at the beginning of May. Could have a bump, then go down a bit in June, and then we only go higher into the end of the year. Silver could see downward pressure, but then we will go higher. Technicals are looking good. We are now at 1,800. If we can break this resistance, then it's going higher. Charles nanocycle, we are probably somewhere here at the bottom, and gold will be moving higher in the next 2 to 3 years. So all is looking well. I have added a last point here, which is the gold miner bullish percent index, and it gives us an indication on the sentiment on gold. So if we look at a long-term chart, if this sentiment is very low, that means that gold is bottoming out. This is a top, this is a bottom, this is a top, and this is the bottom. So we are now actually on average here, but there is still potential to go higher. We are not at greed levels yet. So I think there is a chance that gold is going higher in the coming months. Let's take a look at inflation data. we can see that the producer prices are going very high, and this will probably lead to higher CPI for the consumer. The PCE is at 1.7%, which is still below 2%, which means the Fed will not hike rates, because this PCE needs to go above 2% before they will think about hiking rates. The University of Michigan inflation expectation is at 3.1, a little bit lower than in February, but still 3% is high inflation. Also wanted to show this chart. Look at the PCE. The PCE is at 10% year over year. This is really high. If you look at the history, this is typically at 10% here in 1980, where we had a lot of inflation. This went down and stayed at 5%, and now we have a spike back to 10%. So what is the PCE? The PCE is a broader scope than the CPI, because it also includes non-profit institutions that serve households. So it is a broader measure than the CPI that is always really low. They call it the CPI, and the PCE is a broader index, and you can see that we have a lot of inflation here, 10%. So I expect the CPI to eventually catch up to the PCE. So we are going to expect a lot of inflation in the coming months. Let's take a look at the balance sheets. The ECB is happily printing money. You can see this going higher. The Fed is printing less money, but is also going higher. And when we look at the balance sheet item here, then we can see that cash balance is going down. That's this purple line here. And that cash balance is going into reserves. Reserves are going up. And these reserves will eventually be moved into currency in circulation, which is this blue line. And that will bring in inflation. So we need a few months to see this inflation coming through, but there's a lot of money that's going to be injected in the economy. Just a reminder here, this is the balance sheet of the Fed. We have assets and we have liabilities. So the assets are the mortgage-backed securities and the treasuries. And for the liabilities, we have the currency in circulation and the bank reserves. And this is the cash balance of the treasury. Now, what they want to do is increase the currency in circulation. They want inflation, so they want to get this up. And to get this up, you need to reduce reserves, of course. So these reserves will be injected into the economy via currency. Now, if you do this, you will come to problems here, because if you don't have reserves, you have illiquid markets. So the Fed needs to increase these reserves back up. And to do this, you need to increase the assets. So they're buying treasuries and mortgage-backed securities to increase the assets. And therefore, the reserves will stay constant while the currency in circulation goes up. So that's what's happening now. They are increasing the balance sheet, that's this red line. By increasing this, they also increase the cash in the treasury, that's this line here. And then they can inject this cash into the bank reserves. So this goes down, bank reserves go up. And then the next step is they will decrease this back to here to make it constant. So get these reserves constant again and increase the currency in circulation by this amount. So that will be the inflation that's coming in. and we will expect a lot of inflation at the end of this year. Money supply is rising. All of these items are rising. You can even see here the currency in circulation is rising a bit faster here. And that means we have inflation. We are not in deflation yet. I don't think we will ever get into deflation. The trade deficit, we had trade deficit numbers. Of course, they were bad. So we had 70 billion deficit in the latest month. You can see here also that the services deficit, this is a surplus. Services surplus is diminishing. So that's very bad for the USA. And also the goods deficit is rising. So you want to see this trend upwards, but for the USA, it's trending down. So the USA is in a dire situation. Also visible here, deficits are rising. This gap has still not closed, so I expect that the deficits will stay and keep on rising. Let's take a look at the capacity utilization. It has stalled here at 74%, but it is apparently starting to rise. So that will be good for the inflation numbers. This chart, these are the excess reserves. I wanted to talk about this because something is happening here. Something bad. So look at the loans and leases. So the loans and leases, we thought that it would go up. So at this point, I thought that bank stocks were actually a good investment because the loans are going up. But somewhere here in March, something happened. So now the loans are going back down. And do you know why this is happening? Well, the answer lies in the bond yields, of course. So we had a massive rise in the bond yields in March. That's this rise here. And due to this rise in bond yields, we see that the loans went down. So if the bond yields rise too fast, then nobody will take out loans. And that's what we see here. So I don't think that bond yields can go up much higher than this level at 1.6%. Otherwise, banks will not be able to do these loans anymore. And that is very good for gold, of course, because gold wants to see low bond yields. I've talked about this at the beginning of this video. So watch this. Watch the amount of loans. If this stays at this level and goes down, then this will be very good for gold. Another thing I wanted to talk about is crude oil. Look at this. Crude oil production in the US is cratering. There's not a lot of production anymore. So we will probably see a spike in oil, temporary, but when we don't have any supply of oil, we also don't have any demand. So GDP will be going down at some point. This is very bad for the United States. They are not producing any oil anymore. Also, the Baker Hughes rig counts are not going up anymore. So we have a huge problem in the USA. If you don't produce anything, you don't get to eat. It's that simple. Government stimulus is coming. As you can see here, these are the government transfer payments. Whenever this happens, you will get a rise in broad money and then also a rise in inflation. It's always the same here. This goes first, this, and then this. And now we have the current situation in 2008, again the same thing, over 2 years, and now we have a massive stimulus package coming. Then we get a massive M2 broad money increase, and over a year from now we will see massive inflation coming. So the theme is the same, we will see a lot of inflation. So this is a time to protect yourself. Also, we had Biden capital gains tax that is coming, which was announced somewhere in April. And capital gains is typically bad for GDP. So this will lower the bond yields even more in the future. Stocks will be less attractive, and this will be good for gold. Gold likes low bond yields and high inflation, which is what we will get. This is another evidence on that. Higher tax rates will give lower GDP growth. You can see this here. Biden will increase tax rates, GDP will go down. So this is the theme that we have right now. You are going to see stagnating yields and higher inflation. So you need to be in commodities: gold, silver, platinum, palladium, iron ore, all of them. They will go much higher. And I will see you in the next video.